Welcome, everybody, to this month's edition of Refuel. I'm your host. I'm Scott Burhang, and I have one of my dearest friends in the business with me today. She's a repeat guest on my show, and the reason she's a repeat guest is because she's just so damn smart. Did I butter you up enough?
Thanks for the intro, Scott.
She is.
Hope I can
So
live
my
up
guest
to it.
today is, oh, you always live up to it. My guest today is Dolores Santos. Dolores and I go back to the 80s, where we were 12 when we started. But we have been in the fuel business for a very, very long time. We eat, sleep, and breathe fuel, right? And we want to tell everybody about what's going on in the markets. And today we're going to talk about hedging. We're going to talk about risk management and how important that is to a fuel buyer's buying program. But before we start with that, what is going on today, Dolores? We're up $5 on crude oil today, right?
Yeah, the market is, again, out of control. OPEC said they're going to cut production because they see the economy slowing down. And unfortunately, everybody reacts. So crude's up almost $5. Products are up anywhere from 7 to 10 cents a gallon, depending on your market, of course. This is the NYMEX. But, it just proves that anything can impact the cost of fuel. It could be political, it could be fundamental, it could be real shortages or perceived shortages. And it impacts our buying price. Everything's going to go up tomorrow because of this. Yeah.
Right. So the impact for our viewers, so most of our viewers, those that have trucks and have to buy fuel for the trucks, what this means is that the contract price that you pay, the price point, which is usually tied to either a rack price or it's tied to a spot price, is likely to be dramatically higher tomorrow. Which ties into what we want to talk about today, which is the importance of adopting a risk management strategy with your fuel buying, the fuel buying part of your business. But before we get into that, I wanted to talk to you a little bit about this whole thing with California trucks and emissions and all of this stuff. Walk us through a little bit of that, Dolores, and how you think that's going to play out in California. For those of you who don't know, Dolores is from California, and that is her area of expertise.
So what happens in California usually ends up traveling to other states. But what happened last week is the EPA approved California's plans to begin phasing out diesel-powered trucks. And what that means, they're going to start in 2024, and the light-duty, medium-duty, heavy-duty vehicles, they're going to start phasing out. And Gavin Newsom saying that they hope to have, 40 to 75% zero emissions vehicles by 2040, 2045, where feasible, and 2035, as much as they can. But what's happening is the word feasible means, I'm not sure all the heavy duty trucks will be able to convert to EVs. Now, what's interesting to note is there's a lot of progress being made in hydrogen cell vehicles that will help remove some of the diesel engines and replace them with hydrogen. Why this is important to everybody on this call is that 15 attorney generals from other states and districts have urged the EPA to approve California's stricter requirements for diesel-powered engines. So it's not just going to be California. It is going to be other states that are going to be looking to adopt stricter regulations for diesel-powered trucks. But in reading the articles, I think you saw, Scott, I think those heavy-duty vehicles that travel more than 450 miles, it's going to take a lot longer for them to become zero emissions.
So a lot of changes, of course, everything that California does, like all of the carbon regulations and all of this stuff, slowly moves its way eastward. So as we see this happening, that's a great point. What California is a bellwether for all the other stuff that tends to happen, especially when it comes to energy and fuel and trucks and all of this stuff, right?
And one of the regulations requires manufacturers of heavy-duty vehicles to report back to the EPA. And any company that owns 50 or more vehicles, trucks, are going to have to start reporting, the goods and services they provide with those vehicles. So you can expect, at least in California, to see those requirements rolling out to fleet operators that have more than 50 trucks.
Tell us a little bit, because I've known you for so long, and you're such an incredible resource. How you've worked with fleets and you've sold fuel. Tell us a little bit about your fuel selling experience, and especially when it comes to our friends in the fleet world.
So, as we all know, you can't predict the cost of your fuel. And after labor, it's probably one of your highest costs of doing business. And we had a lot of fleet operators, farmers, other companies that needed to lock in a price for their fuel. Um, Today's a perfect example. You just nobody knows what the price is going to do tomorrow, and it forces people to make decisions to try to hedge or lock in their fuel costs so they have some assurance of a fixed price and supply. Um, I dealt with a lot of companies that had those issues, some smaller companies, and I was willing, as a large distributor, to help them hedge their fuel costs. Much bigger fuel distributors can actually hedge themselves directly, but smaller companies usually look to their fuel distributor to help them hedge their fuel costs, and a good distributor will work with them to help them manage that fuel cost.
So it's funny because you and I, just for our viewers, I think I've mentioned this before, Dolores and I taught a fuel buying class, a physical fuel buying class for many years. And we would always be amazed when we would start out, we'd go around the room and ask people what they did, what their business was, and how much fuel they bought. We would talk to people who bought 500 million gallons a year, and they had the person that was managing the fuel program was the same person that was buying pencils and paper clips and toilet paper, 2 weeks ago, and then they just hand the person the book and they become the fuel buyer. So, what we always taught people, and I kind of want to emphasize this, is that there's really two parts to a smart fuel buying program, right? You have your physical side. So you have a well-written contract. You have a transparent price point that everybody can verify a price. And you have people in your company that can back you up when you're not there. But then there's this other side, which is what we call risk management. So that's kind of what you were just alluding to a little bit. Help me explain to our folks what risk management is, and to dispel a little bit of the myth that kind of surrounds risk management, if you don't mind.
Absolutely, because risk management, right away people think you're gambling, and you're not. You're protecting your fuel costs. And as many people as I dealt with over the years, the most important thing in any risk management program is getting the customer to understand what they're actually doing. And what they're doing is they're locking in a price to protect them against the upside. And I've had customers in the past that have hedged or locked in fuel price over a period of time, and the price went down. And they felt like I was taking advantage of them because the prices were lower. And in reality, when you do hedge fuel, you actually go out and purchase that fuel on a paper trade for a delivery later on. And getting the customer to understand what risk management really is the biggest challenge. It's like having car insurance. You pay the insurance every month, hoping you don't get in an accident. But if you do, then it pays you out. So people lock in prices to help hedge them against what they can't predict, like today, a big run up in the prices.
Well, today is a good example, and today, actually, by today's standards, it's really not as dramatic as it looks. We've seen worse. I mean, we've seen days where prices go up by 20 cents a gallon, and it's not unheard of. You said something before about the gambling aspect. To me, one of the things that I've always tried to explain to people is that not hedging is gambling, right? You're gambling with the market. So let's stay with what you were saying before. So let's say that I'm somebody who is concerned with prices going up and I want to lock in a price, right? So I want to lock in a price for Like, how far out can I really go to lock in a price if I wanted to?
Well, it all depends on your appetite, but I could go out and lock in a price for a year. I mean, on the NYMEX, you could go out 2 years if you want. Um, it all depends on your appetite for risk. A perfect example is farmers. They have to go to the bank to borrow money for their crops. The one price they don't have locked in is their fuel price. The banks want them to hedge their fuel costs so they can come in with a locked in price to put their crops in the ground and harvest them. So it's a perfect example of being able to lock in a price, knowing you're not going to pay more than that. And most customers don't always hedge everything. I would never recommend anybody to hedge all their fuel demand. They should hedge a percentage of it, and it all depends on their type of business and their risk appetite. But they should hedge, in a lot of cases, upwards of half of their fuel volume. I think I had mentioned before, I worked with a gold mine in Nevada, and they had to hedge all of their fuel costs, and it was usually out 6 to 8 months. The banks required it.
So that's interesting because, you brought up a point before, and I remember during my many, many years of working for a price reporting agency, I would deal with customers, and they would call up and they would say, well, yeah, but, I locked in a price, but then the market came off, right? So the prices went dramatically lower. And I would say to them, yeah, okay, that's very true. And you, with the contract and the hedge that you put in, you are not participating in the market's downside. But what you've done is you've locked in a price. So you protected your budget. You know what your price is going to be for whether it's 3 months or 6 months or beyond that. Isn't that the right way to look at it?
Well, that's what I try to educate our customers to do. And I mean, you could buy an option, and you have to pay the premium. The closer to the actual price you buy that option, the more expensive it is. And it's just something you buy and you pay for it. And it doesn't come into play unless the market goes over the price that you selected as your benchmark price. But it's not free. You still have to pay for that option, but it does give you that insurance. Again, we're talking about a way to manage the upside of your fuel cost. And that's what's really important to understand. If the price goes down, you will be buying a lower price, and the product that you hedged is still going to remain at the higher price. But you will also be buying lower price product. But nobody knows what the market's going to do tomorrow. Nobody.
Well, that's the whole thing. And what we've always tried to explain to people, and you and I certainly did it when we taught the classes, if you're a fuel buyer, you don't know what the market is going to do every single day. The market is way up today. We're up $5 on crude. We're up like in excess of 10 cents on products today, but it could flip tomorrow. It could go down 20 cents. It could go down $6 on crude. I mean, it goes every single day. So for buyers, that's their challenge. For sellers, fuel sellers like yourselves, you have to sell into the market every day, right? You can't just take a day off and go, the market's up, it'll go down. You have to be in the market every single day, moving what we used to call the juice, right?
Yeah, I mean, you never know when the price is going up or going down until it happens. I mean, just 10 days ago in March, we had crude at mid-60s, okay? We were in the mid-60s for crude oil, and then it started creeping back up, and then after the announcement yesterday, we hit $80. So it's unpredictable, and anything can impact it. The invasion in Ukraine. Our U.S. diesel inventories are below 5-year averages. Are they going to go back up? The EIA says we'll probably stay below the 5-year average. But remember, fuel will always go to the best market. And if Europe needs it, it's going to go to Europe. If South America needs it, it'll follow the market. I know the government's trying to stop some of the exports. Our government is, but I don't see that happening. But you have to take into account all these things impact the price of your fuel in Kentucky. Whether you like it or not, it has a big impact on what you pay for your fuel.
So we were talking before. So, we have our physical side, right? So we know that we have a contract. It either gets delivered or the truck goes to the rack and all of that. So walk us through the kinds of instruments. So you mentioned an option, but let's talk a little bit about the difference between an outright futures contract, and tell us what the futures market is, if you don't mind, and explain an option just a little bit more, and what kind of dollar commitment I have to put out for either one of those strategies.
So the NYMEX is a paper market, if you will. You can go out and buy futures contracts. You can't buy current month. It always has to be the next month out, but you can buy contracts as far out as 18 months, 2 years if you want, for both crude oil, heating oil or diesel, and gasoline. So it allows you to take a position. You have to put up a margin and you can buy those contracts. One contract is 42,000 gallons. You have to put a margin. If the market goes against you, you have to make a margin call. As long as the market's in your favor, the money goes into your account. The thing about trading strictly on the NYMEX is it doesn't always translate to your current market. There's 7 spot markets in the United States, and each spot market has different dynamics. So the NYMEX is the first level of price, but each spot market has its own issues and its own dynamics. For example, the Gulf Coast, typically very well supplied, lot of refineries, a lot of capacity. They tend to trade under the NYMEX because they're well supplied. The West Coast, on the other hand, tends to trade over the NYMEX because reduced refining capacity, replacement barrels are 2 weeks away, and so they tend to trade over the NYMEX. So if you want to hedge a fuel cost, simply buying a contract on the NYMEX may not reflect your market. So you buy a diesel contract, and let's say you're in Washington State and the market goes 30 cents over the NYMEX, you're not protected because that contract only looks at the NYMEX, not your particular market. There are instruments that will allow you to buy a option, and an option means you set a strike price where you say, I don't want to pay more than this price. And they'll set a value and you pay that premium, and you can tie that back to your spot market. You can buy a fixed price that's tied to your spot market that will look at the paper differential between New York and your market and assess a value. So there are ways to lock in the price. I mean, one of the things I did for my customers is I would buy futures contracts and I would buy a basis differential, meaning the difference between what they think the California market would be to the NYMEX market. I would lock in that price on the futures contract, on the paper contract, and then offer the physical fuel to my customer at a fixed price. So
Okay.
a
So
customer
you were hedging
could,
yourself. You were hedging on the backside.
I was hedging on their behalf because it does take money, it does take volume. And so some companies are just too small. And again, just buying a futures contract isn't necessarily going to protect you in your market. If it follows the NYMEX, do your history, run some history. If it follows the NYMEX, then you might be okay. But if your market doesn't travel or price within the same as the NYMEX, then you have exposure for sure. If you're just doing a futures contract.
And you bring up a really good point. I don't mean to interrupt you, but you bring up a good point. And we've always stressed this: is history is so important when you go into this, to go back. And you were talking about basis differentials. It's always a good idea to have a sense of what your local market at the rack is versus the NYMEX or versus the corresponding spot market. And if you're questioning what spot market ties to your rack, you can always reach out to me and I can help you. And I'm happy to do that or get you to talk to Dolores. So let me ask you, we only have about 5 minutes left, and I do want to ask you this. Once I decide that I need to manage my risk, right? And I need to do something to protect myself and protect my budget and all this. Internally, what is the way to do this? Where do you even start?
What a good point. Never even try to develop a hedging program without bringing in your financial group. I mean, this should be a decision made by management as a group, because if you're going to be hedging, if you're going to do it yourself, you're going to have to put up margin, you're going to have to spend some money. And if you don't have the buy-in of your management and leadership group, it can be very difficult. And once everybody decides, one person needs to management. You can't have 10 people trying to make a decision on whether or not to buy or sell your hedge. So I've learned that the hard way, but it needs to be a group decision, but then one person should be managing it. And you should reach out to your supplier and see what programs they have to offer. And if they don't have a program, then you should find a reputable broker that could help you walk through it. And,
Okay.
it's really important they take your best interests at heart.
The other thing we've always said too, and I want to make this point because I think it's important, it's another relationship that you have to manage, right? So you have the relationship with your physical fuel supplier, and that's an important relationship to have. You want to make sure that it's transparent and you feel comfortable that you're being charged correctly and he's leveraging your spend with a better deal. But this is a whole nother relationship that you have to foster, right? And there could be some real white knuckles. Just real quickly, explain to us what margin is. We only have a few minutes left, but I want to hit what margin is so people understand what that means.
So the CME group, which owns the NYMEX, they require you put up a margin based on the current costs, and those margin amounts change all the time. So I think the last time I looked, it was like $6,500 for one contract of crude oil. So if you had 10 contracts, $65,000 margin. So depending on where the margin is, it could be anywhere from 3,000 to 8,000, depending on the current price. You have to post that margin if you're going to be putting contracts up. So it could be important. And if the market goes against you, yeah, margin calls. You would have to meet that margin call if the market turns against you.
And the reason you do this on the exchange is because the exchange guarantees counterparty performance. So you never get into a situation where somebody defaults and you're left holding the bag. The exchange always makes it whole. Even if somebody has financial issues, it doesn't matter. You don't care. You don't even know who the other counterparty is on the other side. But it's so important because if the market goes the other way, you could get a margin call that could be thousands or hundreds of thousands of dollars, right?
Absolutely.
Yeah.
It's happened.
Didn't you have one that was $1 million once?
Had $1 million margin call. And and it was because I had bought a paper differential, and the company I traded with after 2009, they said, nope, you got to put up a margin, even though I was in the money and they wanted $1 million, and my company went crazy. So we actually put it on Clearport. We actually moved the trade from a one-on-one trade with another company to the NYMEX to Clearport. And I still had to put up a margin call, but it wasn't $1 million. It was about $300,000. But that's why your financial group must be in this decision-making process, because there can be big money. But if you're a smaller company, deal with your supplier because they generally are well-equipped to handle this.
Dolores, we have to wrap it up because we are at the end of our time. I would love, we didn't even really touch on a lot of the things. We were talking about Clearport. I'd like to explain that to people. Will you come back and do a risk management part 2 with me?
Yes, I would love to. It is such an important part of the fuel buying process.
Well, by the way, Dolores has just launched her own consulting company. And what are you calling it? Dolores, what is it?
Santos Consulting Service.
Anyone interested in this person's incredible expertise, please reach out to me and I will put you in touch with Dolores because she's phenomenal. Thank you, my dear friend. And we'll do this again. We'll come back and we'll do part 2.
Thanks, Scott. It's an honor to be on the call. Thank you.
Thank you.